Why is everybody talking about a 50-year mortgage, and is it really a bad idea? Let's talk about it. Well, first, the president posted this picture on X, and he also did an interview on Fox News where he talked about introducing a 50-year mortgage as a way to help more people buy homes. The idea being that the longer you stretch out a loan, the lower your monthly payments are, and the more manageable the monthly payments are. And I use the term manageable deliberately because overall, it doesn't make the loan more affordable, and I'll show you. It's really expensive to buy a house right now. The average price for a house is $375,000, and the average monthly mortgage payment is about $2,500 a month. So why would a 50-year loan that makes the monthly mortgage payment go down not be a good thing? So take a look at these numbers. This comes from an article that was written by Matt Schultz in LendingTree. This is about a $500,000 loan with a 7% APR, so 7% interest rate. And if you look here, you can see that yes, if you have a 15-year mortgage, then you're gonna have a pretty high mortgage payment monthly. So it's almost $4,500 a month, that's a lot. If you stretch it out to a 30-year mortgage, you've got about a $3,300 monthly payment. If you stretch it even further to a 50-year mortgage, it goes down to $3,000, which makes it arguably more affordable, right? But then take a look at the next column. How much interest did you actually pay? Well, in the 15-year mortgage, you're gonna pay the price of the house plus the interest that you paid. So you're getting the house for about $800,000. When you get to the 30-year mortgage, you're paying almost $700,000 on top of the $500,000 you paid for the house in just interest. When you stretch it out over 50 years, you are adding $1.3 million to a $500,000 house, which means you're paying close to $1.8 million for a $500,000 house just so you can stretch out the payments. And the response has been, well, then I'll just refinance when the market gets better and interest rates get lower, and then I pay less interest, right? And there are a lot of ifs with that statement. If interest rates go down enough to make a difference, if you have the credit to refinance, and if you have the equity to qualify to refinance. And what is equity? Equity is the difference between the market value and how much you owe. So on a $500,000 house, let's assume that you've kept it for 10 years and now you've built up some equity in this house. So you go to sell it, and instead of selling it for $500,000, let's just say you sell it for $600,000 and you've paid off some of your loan. So if say you sell it for $600,000 and your loan is now say $300,000, then guess what? 600 minus 300 equals $300,000. So you have $300,000 in equity. So how long would it take you to build equity in a 50-year mortgage? Oh, let me show you. So this is why refinancing may not be an option for a lot of people. And this is from that same article in LendingTree by Matt Schultz. On this side, you have the 50-year mortgage. On this side, you have a 30-year mortgage, still assuming a $500,000 house. But now we've lowered the interest rate to 6.1%. After 10 years of making those almost $3,000 monthly payments, 10 years of that, you've only paid off about $21,000 of the original loan, which means that's your equity. You've got about $21,000 that you've paid off. That's equity in your home. Where if you look at a 30-year mortgage in the same time frame, how much do you have? $80,000. That's how much you've paid off. That's right now your equity. If you go down to 20 years, so now you've been making your payments for 20 solid years, how much have you built up in your house? If you've got a 50-year mortgage, you've paid off about $60,000 of the loan, whereas if you've got a 30-year mortgage, you've paid off about $230,000. Do you see there is a huge difference there? And look at the third line. If you've got a 50-year mortgage and you have been paying for 30 years of your life, you've only paid off about 25% of the original loan. That's crazy. And it actually gets even worse, because you're not going to have the same interest rate on a 50-year mortgage that you would on a 30-year mortgage. It's actually going to be higher. Why? Because the risk is higher. So if you and I are out to lunch and I say, hey, let me borrow 20 bucks, please. I left my wallet in my car. I'll pay you back as soon as we get in the parking lot. You're probably pretty confident that, yeah, she's going to pay me back. If instead I say, hey, let me borrow 20 bucks. I'll pay you back next month. How much confidence do you have now? Banks actually work pretty similarly. So in a 15-year mortgage, the interest rate is going to be lower because there's a shorter time frame and they're more likely to get their money. In a 30-year mortgage, well, now that's going to be a higher interest rate. And with a 50-year mortgage, where there's a much longer time period, the interest rate is going to increase because you better believe that banks are going to make sure that they get paid back. So is a 50-year mortgage a bad thing? It depends. Are you a bank? Are you an investor? Well, if you are, then it's probably very good for you. But for the average consumer, no, it's not a good idea.